Good morning. We're half an hour away from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles, live from the Bloomberg Buy-Side Forum here in Hong Kong.
And I'm Yvonne. Our top stories this morning. Traders watching signs the stimulus-fueled China rally may be running out of steam. Beijing, meanwhile, announcing cash handouts for the poor ahead of that holiday week. Also ahead, New World Development suspends trading in Hong Kong as Bloomberg learns it may axe Adrian Cheng as CEO following the first annual loss in 2 decades. Plus, AI back in the headlines, Micron soaring on a strong forecast, while OpenAI says it's ready to chase profits amid an exodus of senior managers.
Hey, Yvonne, good morning to all our viewers joining us from around the world. We're live here, of course, at the Bloomberg Buy-Side Forum here in Hong Kong. Lots of conversations taking place about, you and I have been covering this all week. This almost historic week that we've seen in Chinese equity markets. I just had to look at some of my screens right now. So, anywhere from 24 billion shares traded yesterday, 1 trillion renminbi in turnover. We are currently on track, and we'll see if we get day 3. That's another conversation. We are currently on track for the best week on the CSI 300 going back to 2020. So we'll see if we get a day 3. We know the sell side has been sold on the idea. Has the buy side bought into this idea as well, this market reset? Among other things, of course, is this big news story. One specific stock, Yvonne, will be very much in focus this hour.
Yeah, New World Development, as you mentioned, we had rumblings of this yesterday. Our team had broke that story that Adrian Cheng might have to be or will be stepping down as CEO after what we've been talking about the last few years and months about debt issues and really the profit losses surrounding this developer. So we'll see if that comes out. But yes, earnings also come out later on today as well. But as you mentioned, in the bigger backdrop of things at this buy-side forum, a lot of questions on whether they are buying in on this China reflation story. After 2 historic days, as you say, across markets, we're seeing some signs of fatigue already.
But absolutely. I think we have a really great story out, somewhat that is a great tangent to the buy-side conversation, where you do have, I think, data from Goldman Sachs and the prime brokerage that on Tuesday, this massive inflow from hedge funds. Now, do we get a sustained flow? It's another question as well. We have a great lineup of guests coming through here from the buy-side forum, and you probably hear the program beginning right behind me as well. Christopher Hui, the Financial Services Secretary, will be joining us in about 20 minutes or so. He's actually set to speak in about 5 minutes or so if we are on time. Effectively, all things fixed income. We're talking all things private markets as well. And also, as it pertains to what do Chinese funds and where the flows now pointing to e-funds, will actually be joining us at the top of the next hour. So, suffice to say, stay tuned. Lots in store here from on the ground here.
Yeah, just taking a look at the market check here right now. I'm taking a look at Asian stocks. We're still hovering around those 2-year highs, and it really has been that sort of China-led sort of rally here. But then again, we'll see how this all plays out. We're still punching some decent gains here. Obviously, when you take a look at the dollar surge that we saw overnight, that's weakening the yen. We saw 1% weakness in the Aussie, the Kiwi, some of the G10 players as well, which is helping the likes of the Nikkei 225. We're seeing gains of about 2%. But it's not so much about the China story, because it's more about the AI story that is kind of catching that baton now from what we've been seeing in China. Because overnight, whether it was the Nasdaq Golden Dragon, some of these ETFs that are listed in U.S. that track China all started to falter. Even towards the late session yesterday here in Hong Kong as well as in Shanghai, you started to see signs of this momentum being lost here, especially in commodities as well. Take a look at iron ore. We're well below that 100 level, of course, according to futures in Singapore. So there you go. You take a look at some of these chip stocks. You got to thank Micron for that. Strong forecast coming through from the chip maker. That's really helping the likes of SK Hynix, Tokyo Electron's up some 6.5% here right now. Taiwan Semi just coming online. There you go. You're seeing gains of 1%. SK Hynix, meanwhile, also announcing they've begun that advanced AI chip production as well. That's helping helping to lead to gains of more than 8% right now. The approach to the open is looking like this. So as we mentioned, right, it wasn't just Chinese assets, but commodities that are starting to at least get to the fact that maybe we need more than just monetary policy to fuel this rally. Does this announcement we got from CCTV yesterday about cash handouts for the poor enough? There wasn't a whole lot of details there. We'll get to Min Min Lo on that in just a bit. But we're flat when it comes to futures here this morning. 203 for your Chinese 10-year yield and 702.64 for dollar China here right now. For more, Dave, we got to talk more about what goes on next.
Yeah, I mean, we were surprised by day one. We were excited about day two. Day three, we have a question mark on that, certainly given the price action overnight. But, I think the point that you also bring up as well, and that we've heard from a lot of analysts this week, is that many of the things, including the cash handouts to the poor, are all new measures, right? So have we finally turned the page here? Let's get a sense of where funds are going and fund flows. In fact, fantastic story on this. Abhishek Vishnoi, our senior equities reporter, joining us right now out of Singapore. Abhishek, fantastic story here. Get us up to speed. Talk to us about the data. And where's the money going? And is there a sense that this is simply beyond a tactical trade at this point?
Yeah, so if you look at what we have reported, hedge funds are coming in, hot money is coming in. There's an element of short covering as well here, but the long-only aspect of it is still missing. The aspect of locals coming into droves, that is also missing. So the long-term money is still missing from the picture. So it is slightly better than a tactical trade right now, but it's still falling short of calling it a U-turn or a structural bull market. But having said that, there has been a lot of comparison between what's happening in China and what has happened in Japan. Market is making the narrative day by day. We are up 4% and we are very bullish. We are up less than 1%. We are less bullish. Nasdaq Golden Dragon is down. We are sort of bearish. But the thing is, markets are made by human beings. We learn from our mistakes, from experience, from others' mistakes. So the Japanification aspect of China, it won't be like the lost decades. There would be a cycle, but it'll be a shorter cycle. And we have lived with this world of, lower growth in China, China's changing role in supply chains and elsewhere. So this has been known for a while. So the hope is that, market is going in a direction where it expects policymakers to do something more meaningful on the fiscal side as well. And that's where the cycle changes. That's where you start thinking about who would be the new champions who will be, championing this new growth regime in China. So all in all, right now, the money, the flows, what they're saying is that it's lower for longer kind of regime on valuations and also on rates. Now, lower for longer rates have been actually good for valuation. So I would say, given all this and given how things have panned out historically in markets, we are closer to being more optimistic than pessimistic on China at this point in time.
And Abhishek, one key element from the stimulus list that we got was the PBOC is funding this. Are there parts of the market that could benefit the most? And is it material enough, you think?
Yeah, I think it's material enough. I think we have seen a lot of dividends, buybacks being fueled by debt and cheap money in the US in the last few years and in Japan as well. So similar thing is happening here. Central bank has come in. It's infusing liquidity. It's saying you can take money from me at about 2.2% and fund buybacks. Our reporters did an analysis. They ran the numbers. Looks like CSI 300 index, which means the large cap index, large cap stocks, are better poised to gain from this aspect of central banks funding, and looks like most of the stocks there, which are part of the consumer story, which are part of the financial industry, they are in a better position, more primed to gain from this. Almost all of them are giving dividend yields or buyback yields in excess of 2.5%. So it's like an arbitrage situation. Take the money at 2.25, give a buyback or dividend at 2.5%, and there is this arbitrage which is going to better the shareholder returns too. So, despite this down trading in consumption, the silver lining to me is that despite this down trading in consumption, actually consumer stocks are better primed to gain from all these efforts.
Abhishek, thank you. Our senior equities reporter, Abhishek Vishnoy, there joining us out of Singapore. On to another top story here this morning. China is giving out one-off cash handouts to people in extreme poverty in a rare announcement of direct aid. For more, let's bring in our China correspondent, Min Lo. We've heard from economists for months now that this is what's needed to shore up consumption. We're finally getting some details of it. What more do we know?
Yeah, actually, it's a very surprising move because we know President Xi has traditionally been quite resistant to the sort of welfareism that Chinese officials say could encourage laziness. But yet, as you said, we've been hearing so many calls from economists for this direct handout, and finally they're heeding that call. Maybe the state of the economy is causing them to reconsider this. We don't have a lot of details as to how big of a handout it is, but we do know that about 4.7 million people are in extreme poverty. They could benefit from this. The handout is supposed to be given out before that Golden Week holiday, traditionally a time where there is peak travel and spending. But of course, you might ask, the extreme poor, are they going to actually go out and spend on holiday? Maybe not, but perhaps it might give a boost to the consumer staple stocks, which has been one of the laggards in the Chinese economy so far this year.
Yeah, the Chinese cabinet has also called for strengthening the country's job market by resolving structural issues, promoting wage growth. How about are they suggesting to do so now?
Yeah, so the State Council has issued a 24-point guideline that include measures to guide companies to provide a training base for vocational skills training, as well as to gradually increase wage growth and some benefits for graduates who haven't been able to find a job for 2 years after graduation. And this perhaps a sign that the government is acknowledging that they need to make full employment a priority, that they will coordinate the industrial, monetary and fiscal policy towards this, because we saw that record high youth unemployment back in August of over 18%. A big part is driven by that structural mismatch, because many of these highly educated youths are looking for white-collar jobs, but it's the factories that are looking for workers. So that's why they are beefing up vocational training, and also that income stagnation was a key barrier to consumers going out to spend as well. And also, if you have a big group of people who are unemployed, that also poses a source of social instability. So we're seeing the government really paying full attention to this now to hopefully boost spending, especially ahead of the Golden Week.
All right, Min, thank you. Our China correspondent, Min Lo there. We just have some breaking news. According to the New York Times, they are reporting that the New York City Mayor, Eric Adams, has been indicted after a federal corruption probe. This is after we've been hearing from a lot of reports and calls from lawmakers for the mayor to resign and to stop governing New York City. Certainly we'll continue to watch this here. But yes, we have learning that the New York City mayor indicted on a federal corruption probe. And this is according to people with knowledge of the matter. The indictment is sealed. It's not yet clear what charge or charges Adam will face, according to the Times. And that is the latest that we'll hear. We'll bring you more updates once they come through. Dave.
Yeah, we're jumping back and forth between a lot of top stories today, Yvonne, and just looking at live pictures right now from the Bloomberg Buy-Side Forum, and things have just begun a couple of minutes into the conference today. On your screens right now for our viewers is Christopher Hui. He is giving the keynote speech, and in a couple of minutes, if things go on schedule, he'll be joining us here, of course, on our set here at the forum, so stay tuned for that. Futures are pointing higher, 0.3 of 1%, counting down to the open of trade, a Thursday session. Just 16 good minutes away in Shanghai, in Shenzhen, and here in Hong Kong. You're watching The China Show. Good morning.
All right, your rand reference rate just coming through here, 703.54 against the dollar. So it is slightly weaker than what is expected here today, and also just reflecting that dollar surge that we got overnight. As you can see, dollar China back above that 7 handle here right now. Well, the Bloomberg Buy-Side Forum is underway in Hong Kong and bringing together senior leaders and experts in global financial markets. Dave, you have your next guest joining you right there.
Yeah, Dennis Falk is here with us on set, head of ETF portfolio management at Mirae Asset Global Investments here in Hong Kong. So we're talking all things equity markets, fixed income, what strategies work, and if we have time, we'll see if we can talk about EM exposure at this point. Dennis, nice to see you and good morning.
Nice to see you. Good morning.
The market, the main topic in markets, global markets this week has been this resurgence in China. And I'm wondering from your perspective, I mean, you see all the flows in the ETF space. What strategies do you think have worked, and where do you see those funds going now?
Yeah, that's a very great question and very great time to talk about Hong Kong China equity market today. Of course, for the last 2 days we have been seeing very strong rebound given all the monetary easing policy by the Chinese PBOC. And then what we can see, year-to-date wise, I can see, especially for those Hong Kong China equity, they're paying high dividend. The basket has been outperforming quite significantly against the broad-based benchmark. I think this actually shows that, in terms of valuation, we're seeing, start to be very attractive. And then for the last 2 days, we also see high dividend basket also rally quite a lot. And then what we are seeing is that, given all the, Fed easing cycle, or, people are looking for more bargain, within this region, we would probably see continuous inflow in terms of the high dividend stock in this region.
The high, I'm glad you brought it up, because the high dividend strategy has been seen as, to your point, it's outperformed. It was seen as a defensive play given the broader bear market in China. And I'm wondering, to your point, do you think it remains to give investors alpha, given that there could be a pivot to other unloved parts of the equity market?
Yeah. Of course, what we can see is that there will be some volatility still, maybe in near future. But what we are seeing is that, given some of the, Hong Kong and China equity, they are paying quite consistent dividend. In terms of the PE ratio, they are very attractive. Most of these high dividend stocks are below 7, and given the track record of paying consistent dividend, I believe that when a lot of global asset allocators or institutional investors, when they redeploy their capital, into Hong Kong and China equity market, I think high dividend stock definitely these may not be seen as defensive play, but that's a very well positioned when they feel that volatility is still there. But the thing is that they still want to deploy their capital in this region.
Dennis, it's Yvonne over here in the Hong Kong studio. What do you make of this move that we've seen? Do you think that there's something that's long-lasting this time around, that the stimulus bliss is a bit more of a game changer than previous sort of stimulus that we've heard from policymakers? And is there anything more to this than just some sort of technical rebound?
Yeah, sure. That's a great question. Of course, no one has crystal ball, but the thing is that what we are seeing is that, starting from year to date, I can see the high dividend yield stock in Hong Kong equity market and China equity market has already attracted some, traction, both in Hong Kong ETF market and also in onshore China. If you see the number of launches in onshore China ETF market, we have been seeing a lot of high dividend launch. That's the very good indication that, there could be potentially interesting flow there. And of course, in terms of the rebound, it takes time, for these policies to actually, get into play, into the, Chinese economy. But the thing is that, what we're seeing is that in the global rate cut cycle, definitely in terms of the emerging market inflow, that would be beneficial for the emerging market.
Yeah, well, talk about the role of EM now. Do you think global investors should be increasing their or decreasing their exposure, given it's not just the Fed that's cutting, it's also almost everyone else, apart from a few central banks like the BOJ?
Yep, sure. Yeah, that's a very interesting observation. I think, the thing is that, in terms of a monetary policy globally, I think Federal Reserve still play a very dominant role.
Okay.
The rate cut cycle started already, and then everyone is aware. And then for the fixed income manager, when they deploy the capital, either they play more duration play, they go for longer duration, because the thing is that they believe that the rate cut would play into, longer term, or, they start to think about spread and also maybe currency impact. I think the thing is that, when you take a look at the current spread, I think in terms of the IG, it's still very narrow. I think more and more people may start to consider the FX impact, whether, the emerging market currency would have potential to appreciate. But given relatively solid, solid economic structure in terms of the Asian economy, I think potentially the Asian emerging market currency potentially will have some, potential to appreciate.
And, who knows, we might even get Korea being included, of course, in that bond inclusion. Well, we could talk about that next time. What do you think, what fixed income strategies do you think are the most appropriate? You mentioned duration. I mean, can we still add duration at this point, given how much treasuries have rallied? And, is it absolute yield? Is it do I play an income? Like what makes sense at this point in time?
I think in terms of the current yield curve environment, what you can see is that after the rate cut decision, I think the long-term yield beyond 3 years has been quite stable. What it means is that it's kind of like expected. The Federal Reserve rate cut decision only affecting short-term end of the yield curve. I think the lowest point is around 2 to 3 years. What we can see is that the investors are still very concerned about the upcoming U.S. presidential election, the outcome. And the thing is that everyone in fixed income world actually is well aware that the long-term yield really depends on demand and supply of the long-term bond. So that's the most important thing for people to watch.
If inflation is no longer the biggest risk for both fixed income and equity markets, what is the biggest risk right now?
Yeah, it's kind of like, of course, as an investment manager, we always think about any risk that we miss out. I believe that one of the biggest risks that we have maybe the market had not be priced in is that what if the inflation hit up again? The thing is that U.S. economy is still very solid place. People keep talking about soft landing, no hard landing scenario. But the thing is that what if the economy really hits up again? What would be next? I think that's something that the market still continue to find out, and then that's why if you see a lot of fixed income movement, of course it price in the rate cut, maybe 75 basis point, 1% very quickly. But the thing is that beyond that, people would not expect that to naturally go back to the maybe pre-COVID crisis level, or even go back to 2008.
Dennis, thank you much so for joining us. Dennis Falk, there, head of ETF portfolio management at Mirae Asset Global Investments in Hong Kong. Take a look at when it comes to your pre-market here this morning, and of course we're seeing futures slightly in the negative territory. So we are seeing signs that perhaps this rally is fading in some way. The Hang Seng, though, take a look at that. We are seeing the pre-market there up about 1%. So certainly one to watch of whether we can extend these gains on the Hang Seng after things did kind of lose a bit of momentum towards late part of the day yesterday. This is Bloomberg. Looks like we are seeing a day 3 of gains here when it comes to the Hang Seng. We're up about 1%. It's really been led by this whole AI-driven story. HS Tech is up 1.5%, and Baidu seems to be the leader so far on the board with 3% gains here so far. And watching very closely that dollar-China trade, now well above that 7 handle here once again. And is it really due to the fundamentals and a prospect of more stimulus underway? If you take a look at this chart, it shows maybe not, because look at the RMB against the basket. It's actually been weakening here. So really, is this really dollar weakness that is sending that RMB higher of late? We got the open coming up next. This is Bloomberg.
Good morning from Hong Kong. Welcome back. You're watching the China Show. To all our viewers just joining us right now, so a couple of big stories right now. It looks like we'll be getting day 3 as far as Hong Kong is concerned. It's number 1. Number 2 is we're looking out for any developments out of New World. That's the big property developer, of course, in Hong Kong. Amid reports, our reporting that the CEO might be replaced, Cheng, and we do understand when part of the plan to usher in a new hope, a whole new world. And Yvonne, we just finished the speech. Christopher Hui will be joining us in a couple of minutes. I understand he just stepped off stage, so he'll be coming here and set to have a conversation around Hong Kong. Apart from that, many other stories, of course. What else are you watching?
Yeah, it's a good day for Hong Kong, too. We were thinking that maybe this stock rally was petering out in some ways, or just given the overnight action. And you're actually seeing, when it comes to Hong Kong, doing a little bit better than what we're seeing onshore. There you go. We're flat when it comes to Shanghai Composite, as well as just a slight declines in the CSI 300. But this is after yesterday. We basically saw HS Tech erase a gain of nearly 4%. HSCEI only ended the day slightly higher. So things are still looking pretty mixed here right now. You're still seeing that downside when it comes to commodities. So things are also slowing down there when it it comes to steel, copper here this morning. But CGB yields continue on this rally, right? So it seems like that push and pull. We're seeing a little bit more money heading back into this bond market here today. We're watching some of these large caps like Huichao, CATL. Not a whole lot of movement here this morning, but we're watching very closely how Hong Kong does, because it seems like things are still trugging along, and we're actually doing quite well on day 3 of this rally. There you go. Hang Seng up 0.6%. HS Tech is really fueling that here this morning. MSCI China also seeing some pretty punchy gains here right now. What we're going to see is the likes of Baidu. There you go. That's really what's leading HS Tech here this morning. Perhaps the Micron sort of strong forecast that we saw from there, that's really helping some of these chip makers, is helping that whole AI trade across the region here today. Tencent is also up 0.7%. But yesterday, that stock basically went from a surge to basically back to levels that we saw at the beginning of the session as well. Alibaba's up 1.5%. And of course, as you mentioned about New World, suspending trading in Hong Kong. It's interesting, right? There's rumors that they might be replacing Adrian Cheng as the CEO. Analysts that we've been talking to say that could be a way to boost investors' confidence in the developer here. It could be a reset for the company's priorities. It could step up the plan to raise liquidity through these asset disposals and the like. So we're watching very closely what developments come through for New World here today. In terms of what movers, it is about that cash handout story, whether this has any sort of impact on the consumer sector here. Barclays had an interesting note saying, look, this is really the pain trade, right? Are we likely going to see more of this sort of rally spread to the more cyclical parts of this market? You are seeing a little bit of that here today, but Trip.com slightly up just about 0.1%. Not a whole lot of movement there. But we're also watching news of Prosus said to have exited that stake in Trip.com. Chip suppliers, chip stocks, the like, we're watching very closely. Given that Micron story, that certainly is one thing we're watching here. And there you go, ASMPT is up close to 3% here today. Speaking of which, we're getting more details on possible changes at ChatGPT creator OpenAI. Bloomberg has learned the company may give CEO Sam Altman a 7% stake. Let's bring in our tech reporter, Annabelle Jewelers. This could be a major shift.
Well, it certainly would be a bit of an about turn. I mean, Sam Altman is someone who in the past has really said that he didn't want to have any sort of equity stake in the company. He was telling people that he already had enough money and that this was a company that was supposed to be benefiting society broadly and not necessarily himself. So this reporting that we have now that OpenAI is mulling giving him a 7% stake is particularly significant in light of that. It does also speak to this bigger story that we've also been talking around as well, which is that OpenAI is looking at changing the structure of the business. So you think about the origins of OpenAI. It was established back in 2015 as a not-for-profit. And the goal of it was developing AI in a way that was responsible, but also that helped society. Obviously, it started to get a lot of interest. It started to get a lot of funding from the likes of Microsoft around 2019. It changed the structure of the company to create a subsidiary where it had a for-profit business that sat underneath the broader non-for-profit structure. That sort of structure and the tension around that really reached a head in November last year. We had that ousting of Sam Altman at that time. He, of course, came back to the business. But again, we're hearing that now the actual structure of the company could finally be changed. A for-profit one put in place that still has that sort of goal as well of helping society.
This is at a time we're seeing a bit of an exodus when it comes to senior management in the company.
Absolutely, yeah. We've seen a lot of key leaders at the company leaving the business in recent months, and the latest one just overnight is Mirae. So she's the CTO of the business. She played a really key role in the rollout of ChatGPT, the voice assistant feature that we saw this week as well. Image generation software. She's been really pivotal. She even actually was CEO for a period when Sam Altman was ousted in November of last year. So she's saying that essentially she's going to take on more personal projects. Her departure date itself is not set just yet, but Sam Altman has been reflecting on this on X, saying that leadership changes are sort of a natural part of any business. And so, yes, he's saddened, of course, by the news, but the company will move on. He says they've been developing a number of talent at the company to take on these more senior leadership positions. They have been expected to be holding a meeting that kicked off in the last hour or so with those senior people at the business. We'll wait for any sort of updates from that, but certainly caught a lot of people by surprise.
All right, Belle, thank you. Annabelle Jewelers there, our Asia Tech reporter. Just getting some lines here when it comes to the RBA. So they're releasing this financial stability review. And there have been some highlights here, in particular when it comes to China. So offshore risks include China financial sector imbalances. The super funds have potential to amplify these financial shocks, and Australian banks have kept prudent lending standards. Most households and firms, though, have been coping with higher inflation and rates. But overall, they're saying loans an area likely to rise slightly in the period ahead. That's really on the cross. We're taking a look at when it comes to what's been going on with the RBA and how they're looking at interest rates here, and they still stand to be one of the lone central banks that is holding off on cutting rates anytime soon. Perhaps maybe some of the financial risk is one factor here as well. Dave.
Yeah. I mean, they're in a pickle, aren't they? in many ways. I mean, we'll see. I mean, they probably will be one of the last in terms of the being able to put the inflation story behind them. I mean, let's see. But in any case, of course, markets have been running with lower rates, and we'll see what happens there. And certainly a big topic of conversation here at the Bloomberg Buy-Side Forum in terms of the tailwinds for risk assets, right? So you have a Fed that's cutting rates, plus you have all these stimulus measures out of China, perhaps two big tailwinds for risk assets globally. We'll leave you with live pictures coming up out of the Bloomberg Buy-Side Forum taking place in this massive room right behind our set here at the forum. And coming up is our interview with Christopher Hui. This is Bloomberg. Right, welcome back. You're watching The China Show. We're live here at the Bloomberg Buy-Side Forum in the city. Speaking of Hong Kong, there's a Global Financial Centers Index report out earlier this week. In fact, says Hong Kong has reclaimed its top spots in Asia's top financial center, knocking Singapore back to second place in the region. That comes ahead, of course, of the chief executive's annual policy address next month. So the winds are blowing in the right direction, as they say. Joining us here exclusively is Christopher Hui, the Hong Kong Secretary for Financial Services and the Treasury, to talk us through all these key themes. Thank you for joining us and taking the time. I didn't catch your speech, so we'll talk about what you mentioned early on. But let's start there. I mean, we're back to third globally. What do you think has gone well, and where do I send the thank you card?
In fact, if you look at the ranking more deeply, there are, broadly speaking, three set of criteria. One set is more about general business environment in terms of our friendliness to businesses, our talent, and also in terms of our general reputation. So we fare, I must say, very well on these fronts. And the other set of criteria is more financial sector specific, about areas where we are doing well. And in fact, we top in terms of investment management, and also at the same time in terms of insurance, banking. These are areas that we do rather well. So the third bit in terms of the subsector ranking is about general impression of people outside Hong Kong about Hong Kong. And that also has improved a lot. So I would say that generally speaking, we are pleased with the result, and we'll keep on doing what we have been doing.
Areas for improvement, you feel?
We need to do more to engage the market more, and that's why here I'm today at this buy-side forum of Bloomberg. At the same time, I think we need to be able to articulate more in terms of what are the long-term plans for financial services sector. And that's exactly what we've been trying to do in terms of having various type of policy statements on family offices, on virtual assets, and very soon, by the end of this year, we'll have a roadmap in terms of how we get our industry prepared for the international standards on green disclosure.
Oh, okay. Can you give us a little bit more detail? How are those preparations going? What can we expect specifically from the government along those lines?
Yeah, we see sustainability as a key topic globally. And at the same time, Hong Kong has always been at the forefront of embracing that. Against this backdrop, back in March this year, we already have a vision statement issued, basically articulating our goal to comply with the green disclosure standards of the International Sustainability Standards Board. And we are, I would say, the very first among the global financial centers to have done that. And after that, it's about, apart from the vision, we need to go to the details. And that's why, by the end of this year, we have a roadmap highlighting what our listed companies and also huge financial intermediaries are going to do in terms of prepare the industry for the readiness to do this green disclosure by the year 2029, which is the prescribed deadline for the green standards.
Yeah. Seems like we have a lot of time, but that's actually quite a short bit of time.
Yeah.
In terms of, you mentioned the policy address, of course, is coming up next month as well. What can we expect from you guys? Is there anything that's in the oven that you might announce?
Yeah, but of course, we need to keep people in suspense after all, because
well, give us a little bit of give us something to be suspenseful about.
Generally, I think as you see, the Hong Kong economy is recovering. At the same time, we have been recovering rather well vis-a-vis other Asian economies or global economies, and we're expecting a economic growth rate between 2.5 and 3.5%. And at the same time, I would say we've been firing from all cylinders in terms of how we can spur further development in this territory. And that's why in financial service sector, we have been doing a lot in terms of growing the new finance areas, including green, as was mentioned, virtual asset, etc. And the other angle is to see how we can bring more people in. And that's why we are having a host of forums and events, including the coming FinTech Week, Investment Summit, Asia Financial Forum, and Wealth for Good Summit for family offices. And all these are being lined up.
Since you mentioned family offices, let me ask you about that. Are you, I think, is the target 200 family offices by next year? Are you on
250?
250. Are you on track to meet that target?
Definitely.
Okay.
And I think we are more than confident to do that, because I think the attractiveness and attraction to a family office here is very much there and accelerating, I would say. As I highlighted in my speech just now, there are actually 3 sets of dividends that Hong Kong has to offer for the global wealth and also asset management industry. And the first set is about the diversification dividend. With geopolitics, whatever, people are increasingly eager and ready to diversify their asset allocation globally. And Hong Kong is actually, as is a very safe place for their asset, is a very natural choice for them. And the second dividend is about succession, because now you can see that there's a cross-generational transfer of wealth from the first or second to the third. And these type of new asset owners have a different outlook for investment. They're looking for impact investment, charities, art, philanthropy, etc. And Hong Kong, being a very comprehensive cosmopolitan, has everything to offer. And the third bit in terms of dividend is about silver, which I'm sure is not about you and me, it's about people relatively more senior. But at the same time, we see there are tremendous opportunities, because as people age, they have a strong desire to invest in order to protect or to preserve their retirement life. And this, again, is opportunity for all of us.
Yeah, I want to ask you about family offices, but since you mentioned silver, can we just briefly talk about that? So what exactly are, what's the concept? And what should we expect from the government? You mentioned something happening next week, I believe.
Yeah. In fact, there are a number of initiatives already ongoing. I think more structurally, we are trying to revamp our mandatory provident fund regime, which is the pension fund of our Hong Kong working people population, including me, to first of all reduce the administration fees for the funds that are investable by our working population. And how we do that is to use technology. So we are going to have a government-funded digital platform, basically centralize all the in and out of these type of pension payments in such a way that the administration fees applicable to the working population will be lowered. And this whole scheme, that's what we call the EMPF, the Electronic Mandatory Provident Fund, will be fully implemented next year. So it's something ongoing. And the other set of measures that we already announced is less about structural, but more about products. And in fact, next Monday, we will start application for people about 60 years old. So long as you are in possession of a ID card of Hong Kong, you can subscribe for our silver bonds. Basically, it is a bonds issued by the government in Hong Kong dollar with a guaranteed interest rate of 4%.
Okay, so to be eligible, you have to be above 60. In terms of the absolute amount that the government is looking to issue, so how large is that bond, that offering going to be?
We are looking for like 50 billion Hong Kong dollars.
And I would imagine because of the target market, that's not going to be a very long duration bond, is it?
No, it's a 3-year bond.
It's a 3-year bond. And is there a target, on aggregate, how much you're looking to do that? Because that's something new.
I must say, it's not the first time we do that. And if you look at what the result was like over the past few issuances, it has been very popular, especially during the low interest environment. But now, of course, even with the different environment now, we expect this type of issuance will have a very positive reception.
And Hong Kong can't afford to give out 4%?
Yeah,
interest rate.
Yeah,
That's not going to be a problem because it was low interest then. It's slightly higher now, as they say. Let's talk about family offices. So 250, you're confident you'll meet that. How many single and multi-family offices have established their presence in the city this year?
In fact, if you look at the stock concept, we have done we've asked an independent third party to do a report for us, and based on a survey, we have 2,700 single-family offices by early part of this year.
Okay.
And
currently operating.
Yeah, currently operating.
Okay.
And then, if you look at these 2,700 family offices more closely, half of them have AUM about $50 million US.
Okay.
So, but of course, we want to grow more because we only count single-family offices. Because if you talk about multi-family offices, it's more like an asset manager. So it belongs to a different category that we don't include them in our calculation. That said, we have a dedicated team in Invest Hong Kong, basically our investment promotion agency, to cater for the unique needs of family offices who are interested here. And also to cater for that, annually we have a flagship event, what we call the Wealth for Good Summit here in Hong Kong. And we will launch the third version or the third year or third anniversary of that event next March. And this is something that we are now planning for.
Just to pivot to some of the talent schemes and the visa programs that the government has put in place and has really attracted a lot of talent to the city, the bulk, I should say, of course, coming from the mainland. Should we expect those programs to continue to be in place in their current form moving forward?
Yeah. In fact, if you look at the result, I think it's very pleasing in terms of how attractive Hong Kong is as a place to attract talent. And that's why, back to your first question about the Financial Center Index, talent is one of the areas that we top in terms of the ranking. And that aside, apart from talent, we also want capital. And that's why we have launched a capital investment scheme, basically to allow people with 30 million Hong Kong dollars invested in Hong Kong. We welcome them to come and reside here and to gain a PR eventually. So far, we have received more than 550 applications since March this year when we launched it.
Okay.
And then we are expecting more than 15 billion Hong Kong dollars injecting into our market with those applications.
Have you approved all of those? Like what?
Yes, I think, but they are in different stages of the application.
Okay.
And so far, when I talk about the 550, they are rather in the advanced stage.
Right. I need to ask you about geopolitics. Some comments you've had recently, and I'm sure you've seen the comments coming out of U.S. officials, that doing business in Hong Kong, to paraphrase it, make it simply, has become more risky. I know you've disagreed with that very, very firmly. What do you think they're missing?
I think the fact that Bloomberg is having this buy-side forum in Hong Kong says a lot. And I'm sure that none of us feels risky when you do your businesses or you live here. And at the same time, I would say Hong Kong is an open society. We're open for businesses. And that's why we're going all out. At the same time, we invite more people to come, basically to see what the general situation here is like.
But what are just to push you on that too, what are some of the concerns that you think have some basis, for example? I mean, there's no doubt that the economy in Hong Kong has become closer with the mainland. And there are changes, they're not necessarily negative changes, of course. And I'm wondering, to your point, how do we make things better here in Hong Kong? What do you think the concerns are that need to be addressed?
I think if you look at how we position ourselves, that's very clear. Okay. We are a gateway between the mainland and the rest of the world. And Hong Kong has been and will continue to be in such a role. Right. And like, for example, if you look at how we have been introducing enhancements to various Connect programs with the mainland, including our Stock Connect program, our Bond Connect, whatever. At the same time, what we try to do is launching more products on the RMB front. What we try to do is to be this link and to even stronger in this rather geopolitically concerned world. Because after all, I would say the issues or challenges that we encounter is no different from other jurisdictions in this new world order.
That's fair. Interest rates are coming down. We import our interest rates from the Fed, for example. Do you see the economy improving materially next year? And just to ask you as well, on the job market in Hong Kong, it's been soft as far as deals and front office jobs, for example. Do you have an outlook of the improvements ahead here for the job market?
I think if you look at different sectors of the economy, of course, they are being affected in different ways by the interest rate reduction. Like, for example, with interest rate reduction or with the improved economy that now we are seeing in the financial sector. In fact, our private banking, for example, wealth management, is including more people. From our interactions with industry, especially those from abroad, I think they really see a growing demand for wealth management services. And that's why many foreign banks and international companies are having shops here in order to capitalize on those opportunities.
Chris, thank you so much. Christopher Hui, thank you so much for the time there. Hong Kong Secretary for Financial Services in the Treasury. Before I toss the break, I have, in fact, some research here coming out of our folks at Bloomberg Intelligence that talk about what that I'm about to pass to Christopher and his team. Coming up here on shows, Jeff Lee, Global Equity CIO at eFund Hong Kong, joins us to discuss investor sentiment and fund flows. And given, of course, all the news this week, plenty more ahead, this is The China Show.
All right, we're looking at some of these consumer stocks here in the back of that news of China ready to give some cash handouts to the poor. Just ahead of that Golden Week holiday, that certainly is helping some of the likes of Mirae Group. That's up some 4%. Some of the consumption plays like Qingdao Brewery is up some 3%. Tobacco as well here today. But it really is a tech-driven story here today that's really fueling the gains that we're seeing here in Hong Kong and around the region here. So Tencent, Bilibili, Baidu, and SenseTime were the top movers on HS Tech. You take a look at when it comes to what Tencent is saying. So Morgan Stanley lifting that price target. They still have an overweight on the stock, but they're targeting games, ads recovery, they say, could actually be a better play than NetEase for some ways. Bilibili, Goldman also talking about how it has a highly sticky and under-monetized young user base video platform, now turning to more robust sort of business model for the company. The stock is flying some 8.5% right now. Taking a look at the dashboards here, it really is what we're seeing across Hong Kong that is driving equity sentiment, and it seems like we're seeing day three gain some traction here on this equity rally. We're up 1.2%, 19,355 for the Hang Seng. You're watching The China Show. Welcome back to The China Show. We start with some breaking news in the second hour and possibly more stimulus on its way when it comes to helping some of these Chinese banks. So our sources are telling us that policymakers are considering injecting up to 1 trillion renminbi, that's around $142 billion of capital, into its biggest state banks to increase their capacity to support the struggling economy. This was always been the worry after we saw this week the stimulus splits, a cut to mortgage rates, a cut to loan rates and all the like, that this was going to really weigh on the banking sector. And now it seems like help, or at least some funding, will come along the way of these lenders here, especially will come in the form of issuance of new special sovereign bonds. That's according to people familiar with the matter. We'll get to that story in just a bit in terms of the details and the weeds of all this. Here's the HSI. Right now, we're off some of the session highs here right now, but there you go. We see Hang Seng up for another third day of gains here after we thought that things were going to be faltering a bit here. I think the tech story really helped lift things here today. Not so much maybe the stimulus news, but really we all have not just this injection of capital into banks, but also cash handouts to the poor that might be keeping this rally at least afloat for another day, Dave.
Yeah, this really shows, I think, Yvonne, if you remember, the day after that big rare briefing, which was on Tuesday, the morning after, we were looking at Chinese markets. What also moved, and not a lot of people noticed, were some of the China proxies globally, right? And that's exactly, again, what we're seeing as far as market reaction. So you mentioned the Hang Seng, you mentioned the Chinese currency. The Aussie dollar is rising as well. I'm also seeing iron ore also start to pick up. We were trading below $97. We're now above $97 as far as iron ore prices are concerned. So you really see markets are literally tuning into this market story in China right now for any further clues of any incremental help. And it looks like with this story, we're getting it, Yvonne.
Yeah, and keep in mind, there's still a Politburo meeting that's going to be happening the next few days ahead of that Golden Week holiday. So we are likely to hear a little bit more of possible stimulus measures that could be coming through here in the pipeline. For more, let's bring in our China correspondent, Min Lo, who has more on this top story now. How should we interpret this move?
Yeah, I think we already got a hint of this from the PRC governor that they were going to inject some capital into the banking system. And I guess this time we got a little bit more details that it could be up to $1 trillion yuan, majority of it coming from special sovereign bonds, which I believe doesn't actually count to the top line budget deficit for the year. So it's a fiscal push here as well to support the banks. I don't think we should see it as the banks being distressed, because if you look at the capital adequacy ratio, it is for the big banks still well above the requirement of 8.5%. The average now is about 11.7%. So this is really to support these banks at a time when their profit margins has been hit. It's at about 1.5% as of end June, which is significantly below that threshold of 1.8% that is deemed to be reasonable profits for these banks to keep going. And we have seen the banks time and again being asked to carry out national service to revive the economy, right? With the mortgage rate cuts, that's expected to shave off about 150 billion yuan in annual interest payments that will no longer go to the banks. They were asked to give out interim dividends as well at a time when the profits were already very thin. So hopefully this injection would go some way to also encourage the banks to keep lending, to keep credit growth growing as well.
Yeah, Min-Min, Chinese officials have really opened up their wallets to support this recovery. So on top of this injection to banks, that rare move, if not probably the first time that we've seen Chinese officials come out and said cash handouts for those who need it the most. What can you tell us about that fiscal pump, if you will?
Yeah, this is a very significant move, as you said. It's really a departure from the past where we know President Xi has been extremely resistant towards giving direct cash handout, which Chinese officials have said could encourage laziness. But at this point, we don't have the details as to how big of a handout this would be and eventually how big of a boost it would turn into when it comes to retail spending and GDP growth. But it will benefit the extreme poor, and there are about 4.7 million of them in China. It's supposed to be given out before the October Golden Week holiday. So maybe it would give a little bit of a boost to that travel and holiday spending, although for the extreme poor, maybe they won't be going on a holiday. Maybe it will be perhaps some spending towards household appliances, the consumer staples that have been the laggards in the Chinese economy so far this year. By the way, it's the 75th anniversary of the founding of the PRC. So state media is saying this is a sign that the party and the government are showing their love and care for the citizens.
Yeah, and today the market reaction is really beer stocks. I think tobacco stocks are rallying the back of some of these news here when it comes to cash handouts. And we're also watching very closely what goes on with the banks as well. As Min-Min mentioned, we're tracking very closely if any sort of reaction to this Bloomberg scoop. It looks like right now it's been a mixed picture across some of the big state banks here as well, but we'll see if there's any sort of cross through here right now. We'll take a look at ICBC, Bank of China, the like here. There certainly has been the winners in this market, just given that dividend income yielding sort of play that people have been talking about still are the key sort of strategies as you look at Chinese equities here right now. But there you go. You're seeing a rally there. Postal Savings Bank is up about 2.2% here right now. Taking a look at Asia ex Japan, we talked about, it's not just the Chinese assets with the focus on here, but as Dave mentioned, you're also seeing a bit of more of a revival or a rebound in the commodity side of things after this news. So Brent's up here, iron ore, we're seeing gains about 0.6% at $97, according to futures in Singapore here this morning. The Aussie dollar is catching a slight bid and seem to be benefiting from all this China stimulus. Also, of course, the RBA is still holding hawkish this week as well. So there you go. You are seeing some market reaction here. U.S. futures are punching slightly higher here, and the Nikkei is up 2.5% thanks to that weaker yen that we saw overnight. For more, let's bring in our Asia equities reporter Charlotte Yang to walk us through. It looks like day 3 is still underway for Hong Kong.
Yes.
But what else is in store, you think? We were thinking that things were getting a bit tired, but not so.
So thanks to the banking report, just saw this instant spike both in onshore and Hong Kong. Because before early in the morning, we did see market opening on weaker footing, and I think this is kind of a familiar episode, for Chinese markets when you have this big stimulus coming out, and then you have like the hedge funds coming in to cover some shorts, and also we also this time we also have like report from Goldman saying that there are like real long-term money buying it, but then they will kind of pause a little bit to see what happens next. And like you mentioned, we have this Politburo meeting. We're expecting it to happen in the next 2 days, and people are expecting there might be some measures coming out. And then you have the 7-day long day holiday, which I think that the color from the consumption side will be so important to this market because we know the property side is a long-term thing. So we do want to see if like the movie tickets, if the retailers, they're going to show some positive, signals after all these stimulus signals.
Charlotte, are expectations running maybe slightly too high at this point? Just help us understand where the market mindset is right now, given that, as you point out, we've gotten a lot of new things this week. And is the market running ahead of itself, or is this, I guess, in some ways a proper reset?
I think sentiment-wise, it has fundamentally improved a lot because the way the government is sending out the signals. Investors really like that you give this a package, a holistic package of stimulus, from the monetary side and also the direct tools to support the stock market. And they like how over the day we're seeing more efforts from the government. And I think also like a lot we're hearing some long-term investors saying that this time they're not going into the market to buy specific stocks, but what they are doing is that they're just buying index funds or like using a call option strategy. So in that way, they can help them capture the upside, given that the overall investors' positioning, especially the big money, is still relatively light. So I think at this time, the expectation, people do have high expectations, but it's still looking like we might see some more upside in the near term.
All right, Charlotte, thank you. Charlotte Yang there, our Asia equities reporter, joining us here. We got plenty more ahead. This is Bloomberg.
October 1st. With the election weeks away, the VP candidates are set to face off.
When we fight, you guys are going to get me all fired up again.
Trust Bloomberg for news and analysis.
So is it style or substance, or maybe both? We'll be hearing from Tim Walz and J.D. Vance in prime time.
Yeah, and the question is whether the vice presidential nominees are actually able to move the needle.
Tune in for the CBS News Vice Presidential Debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Columbia University professor and Nobel laureate in economics Joseph Stiglitz says the next phase of U.S.-China relations could create a big opportunity for emerging markets. He spoke to Bloomberg at an event in New York.
The fundamental thing is going to be we're going to be de-risking. We are, which is the vocabulary that Europe uses a lot more than we do, and de-risking where, unfortunately, where a real challenge for the emerging markets and developing countries is going to be China, because we, and the bipartisan view is that China represents a risk
or a threat.
A threat, and I think at this point there's very little evidence of that. China's behaved a little, I would say, naughty in the South China Seas, more aggressively than I think is in its own self-interest. And it's made threats to take over Taiwan. And if you take those threats seriously, you have to say that you need to de-risk. So in that, but it hasn't done beyond that a lot. But we read those signals very strongly. When I say we, the national security and both parties have read those signals very strongly. And so we're taking very aggressive de-risking. And that's an opportunity because all that production, which is in China, will be moving out. Right now, we're in the first stage where there's what I would describe massive circumvention, where goods go from China to Vietnam, China to Mexico. That's just changing the pattern of flow. I think in the next stage, we're going to see a strong U.S. reaction to say, we don't like that circumvention. We're going to have stronger rules of origin. Again, really bad for the seamless world where we were working after World War II, where borders didn't matter. But in that new world, being on the right side is going to be very important. And that is going to be a big opportunity for emerging markets and developing countries, provided it doesn't get too tense where, say, Latin America, which exports a lot of the raw materials to China, isn't told, if you continue to do that, you won't be a place where we feel comfortable buying from you.
And that was the Columbia University professor and Nobel Economics laureate Joseph Stiglitz speaking with our colleague Eric Schatzker in New York. You take a look when it comes to markets here today, and it looks like things are still coming along when it comes to this equity rally. 1.5% gains in the Hang Seng here today. Even the onshore markets are now gaining a little bit more momentum, and we're seeing gains about 0.7%. So day three intact so far. You got to thank what's been going on in the tech sector here. That's also fueling some of the gains that we're seeing on the Nikkei 225. We're seeing punching about 2% up right now, and really just given with that weaker yen story here, that dollar surge overnight. Let's get back to one of our top stories here this morning that just came through across your Bloomberg. Perhaps more stimulus on its way when it comes to China's top state banks, and really how China's weighing injecting about $142 billion of capital into these lenders. For more, let's bring in our Bloomberg Intelligence senior analyst, Francis Chan. Francis, I'm sure you've had a take on maybe on this scoop so far about capital being injected into these state banks. How significant is it?
Well, I believe the central bank in China or Beijing government is prepared to really take some losses in those new measures or stimulus measures, really trying to boost the economy by rescuing or bailing out some of the companies or local governments. That would be my first take. Because these banks, the biggest state banks in China, they have about 3 to 4 percentage points higher than the regulatory minimum a CET1 capital or core equity capital. So in theory, they don't need more capital per se, just to sustain their daily operations, unless they will be asked to take on more risk, more credit risk, i.e. more loan losses. So in this case, that 1 trillion RMB or 142 billion would be for that purpose. That's my first take on that.
Okay, that's an important nuance there, Francis. So just to clarify, what you're saying is this amount, maybe not the whole thing, will go into plugging any recognition of bad loans moving forward, or do you see some of this going into in the form of new credit, which really the economy needs as well, Francis?
The lenders themselves, they have their own set of capitals, and they have been really holding the credit underwriting standard tight in the past. So even after Beijing has been calling them to make more loans to support the economy, we have been seeing some of the really risky sectors. The drawdown has been, I won't say a lot, but modest at best. And now, if you're asking these banks to deviate a little bit from their underwriting standard, they may be needing more capital just to boost their own balance sheet and solvency, so they can absorb those losses. And of course, we are seeing the lingering property market crisis. That's one of the area. Some of the local governments are debt-ridden. We all know about that. Those could be some other areas which may need help. And of course, the SMEs or the retail sectors. Those are all areas which may need more lending boosts to help them, or draw those sectors out of the trough they're facing.
Francis, thank you. Francis Chan there, Bloomberg Intelligence's senior analyst, joining us out of Singapore. As you can see, some of these big banks rallying on that news here today. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. We're live here at the Bloomberg Buy-Side Forum here in the city, and joining us here on set to talk us through all these market moves and maybe what makes sense as far as global equity strategy is concerned moving forward, with the Fed cutting rates as well, mind you. Jeff Lee is with us here, Global Equity CIO at eFunds Hong Kong. Jeff, well, first, it's nice to see you. Thank you for taking the time to speak with us.
Thank you for having me.
There's been a big change in sentiment in greater Chinese market this week. Big deal?
I think it's a good start.
Okay.
Yeah, we do see sentiment increasing.
Yeah.
It's no, to start with, this is with the background of a global central bank easing cycle.
Right.
We're kicking off a global easing cycle.
Yeah.
Which is a very very good environment for the market. And then we can see that our regulator sort of took the window of opportunity to ease as well. So we see positive response from the market to that.
And as a global CIO, does this mean almost lean further into risk assets? What's your outlook for global equities?
Very positive. We're very constructive with global assets.
Okay.
And that, again, this is with the background of global central bank kicking off another easing cycle.
Right.
And in our framework, liquidity take a key role in driving both the economic fundamental and also the market. In fact, we see global liquidity bottomed in end of 2022, and then if you remember, that's where market bottomed.
Yes.
And it continued to improve since then. So we've been quite positive with market ever since then. We've been advising our clients to buy every dip, and it worked quite well. And then with the Fed cutting 50 bips, which is more than market expected,
right?
We see the probability for soft landing has significantly increased. Probably even a chance for a strong market for the coming 12 months.
Yeah, and it seems to your point, you've been advising your clients to go into equity markets. The question previously was it cash or equities? Now it's within equities. What strategies do you think works best? I think in U.S. equity markets we've seen a broadening in and out of the rally away from some of the big winners.
That's right.
China, let's see if it recovers. So what strategies do you think are best at this point within the equity universe?
Right, as you rightly pointed out, in the past, for the last 1 or 2 years, cash is no longer trash. So there was a recent amount of allocation into that asset.
Well, it's still 5%. You still get 5% on cash now.
Indeed.
Yeah.
With US 10-year at 3.8, approaching 3.8, it's still attractive.
Okay.
Just not as attractive as before. At the same time, unless we have a recession, which is not our base case scenario, we are in a soft landing camp.
Right.
And if that's the case, going forward, we think equity will be increasingly more attractive. So in a typical, 60-40 allocation, we would looking to gradually increase the equity allocation.
Okay.
And that's our take.
So within the equity allocation, let's say we overweight equity markets, what strategies within equities do you think make sense? Is it growth oriented? Do we look at tech? I mean, AI has done very, very well.
Absolutely.
Do we still do income, for example? Like, what would the specific advice be?
Absolutely. So, as you pointed out, over the last quite a long period, we have a very much concentration in the market. We see that broadening out. A lower, if we look at the U.S. market or the global market, the concentration for a long time has been on those tech-heavy stocks. And then that's the phenomenon of when we have uncertainty on the economic growth.
Right.
If our prediction is more or less in line, from the next, driven by the easing cycle, we will start to have an economic upturn, and therefore the market, the part of the market that hasn't performed as well, remain relatively attractive, which is the cyclical part of the market.
Right.
Could become a outperformer in an economic upturn, and we're preparing for that. Our multi-asset model is telling us to prepare for economic recovery.
Okay, lead into cyclicals. Very quickly, the last 3 months of the year, I know you oversee offshore equity markets. Onshore, though, where do you think Chinese equities go, including Hong Kong? Let's put it that way.
Absolutely. One thing I would like to point out: the market is very, very cheap.
Yes.
And cheap in two sense. If we look at the first group, which is the traditional growth stocks, the industry leaders with white mode, quite sustainable growth, they're trading at below 10 times PE. And that's attractive.
Okay.
And then there's a second camp we mustn't forget, which is the higher yield stocks, dividend stocks.
Yep.
And these are becoming quite of a focus at the moment for the market, but they're still cheap. We see a lot of company with good cash flow generation.
Yeah.
But trading at 10% dividend yield.
We got to leave it there. Jeff, fantastic. On the positive note, Jeff Lee, the Global Equity CIO at Yvonne Hong Kong.
At 11:29 a.m. in Tokyo, Japanese markets heading into that lunch break, and it is a pretty solid Thursday morning for Tokyo. Here, Nikkei 225 up 2.5%. It's that weaker yen story that's really helping, right? 144 levels for dollar yen here, and the TOPIX is also gaining some 2%. GGB yields up about 1%, kind of following what we saw with Treasuries, basically, which have seen Treasury yields actually rising there for the last 6 out of 8 sort of sessions here. Concerns about new bond supply, especially with that 5-year auction in the U.S. is coming up as well. We're pretty flat on the Asia Pacific, but certainly you take a look at some markets like China, and things are finally, in the last few minutes, gaining a little bit more traction, right? So we had multiple news, whether it was cash handouts to the poor, and then that Bloomberg scoop about capital injection into the state banks. That's helping the HSI, as well as CSI 300 now gain for another day. Developers, which has been the standout sector that really benefit from some of these stimulus blitz that we've heard, it continues for another day. We're up 4.5% for the BI China Developers Index. I believe it's been up for the past 8 sessions here. And we actually have seen more than 20% gains on this benchmark since the lows that we saw just a few weeks ago. Global macro movers is looking like this here today. We continue to see a risk on rally across equities here, thanks to what we saw, this tech-driven sort of rally that's really keeping things afloat here. So you are seeing some sizable gains in some of these Korea names, Taiwan, Japan. Hong Kong certainly has been the top of the leaderboard here today as well. Dave.
Yeah, let's get it back to our coverage here at the Bloomberg Buy Side Forum. And, we've talked at length about public markets, how they've done very, very well. Certainly, given the prolonged bear market we're seeing, well, let's hope that ends, of course, the popularity of private funds has certainly picked up, right? So we have a lot of this conversation around private credit around the region. We've seen a lot of these LPs throw money effectively into a lot of these large funds globally. What is the story, though, as it pertains to Greater China, offshore China, among private funds in the community here? What are the opportunities, given the geopolitics? What are the opportunities and risks? What are the opportunities that people seem to be overlooking, given all the gyrations on the political side? Joining us here on set is Howard Ching, co-chair of the Chinese Overseas Private Funds Association, to give us a sense, really, of how the community is doing. It's nice to see you, and thank you for taking the time. So, first, give me a sense of what you guys do. Like, what is this association about? You guys have been around for 20 years. What do you spend all day doing?
Yeah, thanks, David. COFA, the Chinese Overseas Private Funds Association, is a non-profit, industry-driven initiative that connects Chinese managers with international participants. as you can say, the development of the Chinese private fund industry is around 2 decades, 120 years, and they have been growing so well. And a number of the great managers have been expanding offshore, in particular Hong Kong and Singapore. And this momentum has not stopped it, despite what you mentioned, the bear market. At the same time, international investors and allocators, they are also having a focus on the Greater China market, which is the second largest economy in the world. However, as you know, there is always an information gap between the mainland China and the international market that we aim to address. And that's why COFA is here to offer a unified and comprehensive knowledge sharing platform to represent the voices of the Chinese private fund industry.
How would you describe the fundraising situation among Chinese fund managers going offshore? Has it been a challenging time? And if so, why do you think that is? If not, why not?
This is a great question. So we must look at what is happening perhaps in the past 24 or even 36 months. Which you will see, which is a triggering point. And in fact, you may hear internationally, among globally, there is a so-called the de-risking trend, the ABC sentiment. So what they meant by ABC is about avoidance, investing in the market, anything but China sentiment. However, this sentiment, what we believe is we see the truth and the gap between truth and narrative when it comes to the China market.
What's the difference between truth and narrative?
Well, in most of the, allow me to quote, in most of the...
give me an example.
In most of the, if you attend most of the forums and conference of the alternative investment industry, most of them, they're having in most China field, they will talk about investability in China, which you don't even see that in the past few years. It only happens in these 3 years. And this is, given the reasons, I can give a few of them. The macroeconomics in mainland China, the housing one. However, what we believe is sometimes perhaps the media and the news which exacerbated the situation, and it's really more on the sentiment. But in our point of view, in fact, you mentioned about fundraising. Yes, some investors they already have a plant seed of doubt. The plant seed of doubt, which is quite concerning. But you know this may not be even rational. Otherwise, why are we having the Bloomberg China show now, right? And then, however, we believe it is in fact the generational opportunities, the moment which the best China managers will flow to the top. Allow me to also quote a popular saying in the Chinese community. The bigger the storm, the more expensive the fish. So it means under the really tough, challenging environment, you will see the outstanding alpha generators. In fact, we are still seeing some alpha generators who are delivering double-digit return, which outperforms the market. But obviously, the industry does need a platform for them to voice out and allocate themselves. While it is also important for the international investors they want to know. A number of big family office institutions they want to understand about the China market, but they just don't know how. And therefore, you see, COFA, we are a background, we are a community of comprising fund managers, professionals, and even key industry bodies from Hong Kong and Singapore.
Let me push you on that, though. I mean, to borrow the storm analogy, the more expensive, it's harder to find a fish, though. And, we can get into a very long debate on truth and narrative. The truth is, though, the economy hasn't been doing well. The market is in a 3-year bear market. That's the objective reality. Now, how you interpret that, whether that's opportunity, the Chinese word for opportunity and crisis is the same word, right? So objectively, what do you think are the generational opportunities right now that, agnostic of your politics, international investors should be paying attention to?
Well, the prolonged 3-year bear market. So what we believe is a so-called a generational opportunities for them. However, what we really believe is a more fact-based. Yeah, we advocate evaluation facts and data, and this is what Comfort is here. Yeah. We are as you see in this week, the turning point may have come, the stimulus. Yeah. But having said that, I mean it is our the corporate community. We are, in addition to having a platform, a comprehensive and unified voice for knowledge sharing, and we also advocate and elevate the standards, because when it comes to the fund industry, it's also about the infrastructure, compliance, and also governance. And that's why we have been seeing the industry has been making big progress, especially in these 3 years. Yeah.
Howard, fantastic. Let's have another conversation next time. It seems like we have a lot to cover as far as this, and hopefully you're right. Hopefully things do improve, and this week was a turning point. Howard Ching there, of course, co-chair at the Chinese Overseas Private Funds Association. Yvonne, you probably hear it. It's buzzing here, so I'll send it back to you where it's perhaps a little bit more quiet back in your studios. I can barely hear myself.
All right. We'll get to you back there later on. But yeah, it looks like things are really happening there at the Buy Side Forum. If you are a Bloomberg subscriber, of course, you can catch up with all the interviews that we had from the event by using our interactive function, TV Go. You can join conversations. You can send instant messages to our team and our guests during our live shows. Check it out at TV Go. Well, Hong Kong developer New World Development has suspended shares here in Hong Kong after Bloomberg revealed it may be considering replacing Adrian Cheng as CEO. Earnings also come out a little bit later on today as well. Let's get the details with Shirley Zhao, who helped break this story. Shirley, tell us a little more what we know at this point. What could happen?
Right. So what we know is that New World is considering replacing its current CEO and, the eldest son of Henry Cheng, Adrian Cheng. And they're going to replace him with the current COO, Ma Xiu-cheng. So that's what we learned from sources, but it remains to be seen. I mean, New World's earnings is coming up this afternoon, and we heard that the announcement may come around the time of the earnings. So we'll find out.
Yeah, I mean, obviously this is coming on the back of them dealing with all these debt issues. They've been saddled with that sort of debt load, as well as these write-downs that we've been talking about as well. But for them to actually change the succession plans like this, how rare is that to see that amongst a conglomerate like New World?
This is really rare, especially in Hong Kong among conglomerates, family-owned conglomerates, because as we've seen, the other major conglomerates in Hong Kong, like Cheng, Henderson, and Sun Hung Kai, they're all led by family members. But if Adrian is indeed replaced by Mr. Ma, and that shows that, the family is bringing talents from the outside. And perhaps we can find some clues from the father, Henry Cheng's earlier TV interview. He said that in the case of the family not being able to find suitable talent from within the family, he wouldn't rule out the possibility of bringing outside talents to lead part of the family's business.
Yeah, and how would this departure help the developer in any way? I mean, can it once again restore confidence into New World again?
Yeah, I think a lot of people's opinion about Adrian Cheng is that he was being overtly ambitious on a lot of projects, and he took on a lot of big projects, like multi-billion-dollar projects. For example, the Sky City, the Kai Tak Sports Stadium. Those were good projects, but he took them all at the same time, which,
and during COVID.
Yes. And then, here comes COVID. So, the New World Group has really racked up a lot of debt because of that. So now I think a change in leadership, a lot of, analysts are feeling that exactly as you said, this is a restoration of confidence and feel like, they're turning a new page.
All right, Shirley, thank you. Shirley Zhao there. Great stuff. Our Bloomberg conglomerates and media reporter with that scoop. Of course, we'll bring you any updates if we hear it from New World here today. Some other big corporate stories that we're tracking for you. Internet investing firm Prosus is said to have sold its entire stake in Trip.com in a $743 million block trade. Now, sources say Prosus sold over 14 million shares in Trip.com at around $51 each. Prosus has been gradually selling shares in recent months, and this exit comes about a month after Walmart unwound its 8-year partnership with Chinese e-commerce company JD.com. Boeing is set to meet with union negotiators on Friday as a factory workers' strike in Seattle triggers delays to 737 MAX deliveries across Asia. Korean Air, Vietjet, and Japan Airlines have told Bloomberg that they're either expecting planes to arrive late or concerned about handover dates slipping. Cirium data shows Boeing is due to deliver 981 MAX jets to Asian carriers by 2030, led by Air India and Indonesia's Lion Air.
Yeah, earlier, as I'm going to try and speak above the crowd, which I guess underscores how buzzing the Bloomberg Buy-Side Forum is. So we had an exclusive conversation earlier on with Hong Kong Secretary for Financial Services, Christopher Hui. We began by effectively discussing this report released last week where effectively Hong Kong has now again leapfrogged Singapore to become the #1 financial center in the region and top 3 globally. Have a look.
In fact, if you look at the ranking more deeply, there are, broadly speaking, 3 set of criteria. One set is more about general business environment in terms of our friendliness to businesses, our talent, and also in terms of our general reputation. So we fare, I must say, very well on these fronts. And the other set of criteria is more financial sector specific, about areas where we are doing well. And in fact, we top in terms of investment management and also at the same time in terms of insurance, banking. These are areas that we do rather well. So the third bit in terms of the subsector ranking is about general impression of people of outside Hong Kong about Hong Kong. And that also has improved a lot. So I would say that generally speaking, we are pleased with the result and we'll keep on doing what we have been doing.
Areas for improvement, you feel?
We need to do more to engage the market more, and that's why here I'm today at this buy-side forum of Bloomberg. At the same time, I think we need to be able to articulate more in terms of what are the long-term plans for financial services sector, and that's exactly what we've been trying to do in terms of having various type of policy statements on family offices, on virtual assets, and very soon by the end of this year, we'll have a roadmap in terms of how we get our industry prepared for the international standards on green disclosure.
Oh, okay. Can you give us a little bit more detail? How are those preparations going? What can we expect specifically from the government along those lines?
Yeah, we see sustainability as a key topic globally.
Okay.
And at the same time, Hong Kong has always been at the forefront of embracing that. Against this backdrop, back in March this year, we already have a vision statement issued, basically articulating our goal to comply with the green disclosure standards of the International Sustainability Standards Board. And we are, I would say, the very first among the global financial centers to have done that. And after that, it's about, apart from the vision, we need to go to the details. And that's why, by the end of this year, we have a roadmap highlighting what our listed companies and also huge financial intermediaries are going to do in terms of prepare the industry for the readiness to do this green disclosure by the year 2029, which is the prescribed deadline for the green standards.
Yeah. Seems like we have a lot of time, but that's actually quite a short period of time.
Yeah.
In terms of, you mentioned the policy address, of course, is coming up next month as well. What can we expect from you guys? Is there anything that's in the oven that you might announce?
Yeah, but of course we need to keep people in suspense after all. Because
well, give us a little bit of give us something to be suspenseful about.
Generally, I think as you see, the Hong Kong economy is recovering. At the same time, we have been recovering rather well vis-a-vis other Asian economies or global economies, and we are expecting an economic growth rate between 2.5 and 3.5%. And at the same time, I would say we've been firing from all cylinders in terms of how we can spur further development in this territory. And that's why in financial service sector, we have been doing a lot in terms of growing the new finance areas, including green, as was mentioned, virtual asset, etc. And the other angle is to see how we can bring more people in. And that's why we are having a host of forums, events, including the coming FinTech Week, Investment Summit, Asia Financial Forum, and Wealth for Good Summit for family offices. And all these are being lined up.
Christopher Hui there, Hong Kong Secretary for Financial Services and the Treasury, speaking with David at the Bloomberg Buy-Side Forum. Of course, you can get Insider's Guide to the Money and People Shaking Up the Finance Hub in our Hong Kong edition newsletter that's out every Thursday. You can sign up via Bloomberg.com/newsletters. Make sure to check out the new one today. This is Bloomberg. Well, Meta has unveiled its first pair of augmented reality glasses called Orion. Now, the prototype has lenses that can display text messages, video calls, and even YouTube videos into the user's field of vision. There you see Ed Ludlow checking them out. Meta's Chief Technology Officer Andrew Bosworth told us exclusively that he expects the glasses to become a consumer product within the next decade.
We already have the next two products in development based on the technology we developed for Orion. And we think this is just a proof of how exciting the future is going to be as these technologies become consumer ready.
You may or may not guess that, speak to some of the team and know that that's part of the origin story. My understanding is that this is a future behavioral change that humans have to make, right? Right now I have a smartphone, I have a laptop, and that's the price point you want to come in at. One day Orion or its next generation sibling will be priced at a high-end laptop PC. What is that price point? And is, give me something here. Will I be coming back to Menlo in 10 years and finally looking at it in a consumer form? Or is it something more real than that?
Long before 10 years. I think we're more than 1 year away, less than 10 years away. But we have very clear line of sight to a consumer product. The price isn't clear to us yet. One of the big things going from a prototype like this is understanding what can we learn that allows us to simplify, or what do we need to keep in future designs, and that's going to control where the price lands. But we really want to get this into a price point, a form factor that not just consumers use it, but developers want to build for it.
The breakthrough in technology is actually in a material, silicon carbide, that allows for all of this in the lenses. How's the supply chain look like for silicon carbide for somebody that wants to do consumer tech?
Yeah, silicon carbide was, the first place we looked for super high index glass that's refractive, and that's really important for what we do for these lenses. I will say it's an incredibly difficult material to produce and to work with. And so we are also looking at multiple different materials that we could use to replicate this functionality, and again, at a hopefully more competitive price point.
I'm trying to sort of think holistically about everything that's happened today. When I moved to California 6 years ago, you were a social media company. And then you got absolutely hammered by the markets for being a very big loss-making unit of a hardware company for the metaverse. Now you're very focused on AI. Which of those is it?
It's all of those. I mean, until earlier this year, Facebook's fundamental AI research group reported to me. And I think it's not a loss, it's an investment. And today you got to see for yourself what that kind of investment can get you. And I think that's one of the things where if you are looking towards the future and you realize these curves kind of overlap one after the other, PC and the internet and phones, there is another curve that's going to happen, and we believe it's spatial computing.
And that was Meta's Chief Technology Officer, Andrew Bosworth, speaking exclusively to Bloomberg's Ed Ludlow. Taking a look at what comes to markets here today, and we're certainly focusing on some of these consumption-related stocks here. Certainly a day for consumption, just given this news of cash handouts that could be coming, whether it's Shanghai vouchers or handouts directly to the poor. Exactly what the market has been looking for, it seems. Look at the likes of Nayuki Holdings is up some 10%. Everything from sports apparel, from F&B, XPeng in autos as well. We're seeing XPeng up some 5% here. Vocational education stocks are also doing quite well here. There's been signs of more support for this sector as well from policymakers there. So therefore, you see China East Education up some 5%. as well. And really our scoop here this morning, one of the big stories is really about injecting capital to these state lenders here as they try to help the ailing economy. About $142 billion worth of capital we're hearing into some of these top banks like ICBC and the like there. And they are seemingly all rallying this morning. Coming up in the next hour, we're going to head to Super Return Asia in Singapore to discuss the global economic trajectory with PGIM and the CEO. This is Bloomberg.